Hey everyone, and welcome to this explainer. Today, we're tracing an absolutely wild interconnected chain reaction across global financial markets. We're going to explore this fascinating domino effect that is culminating right before a highly critical Federal Reserve decision. So let's jump right into this and trace how just one single spark on the global stage is literally setting off alarms across every major asset class.
Here is our roadmap for today. We'll start with a market overview, then move into geopolitical heat, DXY, and Fed rates, the paradox of gold, AI bubble fears, and finally, Bitcoin at crossroads. Let's get into it.
Section 1, Market Overview, and a quick look at the board. Looking at the closing numbers from July 24, 2026, the jarring contrast across the board is immediately obvious. You've got the US dollar index, or DXY, sitting perfectly stable, while WTI oil is seeing buying power return, pushing prices right back up. But there's a lot of red here. Gold is facing a sharp drop. The tech-heavy Nasdaq 100, also a sharp drop. And Bitcoin is following suit with a steep decline of its own. This wildly split market is exactly why retail portfolios are feeling so chaotic right now. To understand why everything feels completely disconnected, we have to find the catalyst.
Section 2, Geopolitical Heat, the Catalyst.
Right now, WTI crude oil prices are hovering near the $90 per barrel mark. And what drove this? Well, pure geopolitical tension. Escalating US-Iran conflicts and those recent attacks on oil tankers in the Red Sea have completely jolted the market. I mean, these events alone pushed WTI from the low 80s all the way up to over $93 a barrel at one point. It's wild to think that we're talking about a massive 17.2% explosive jump in just a single week.
But here's where the volatility really rears its head. This market is currently being dictated entirely by the news cycle. Yes, tensions drove prices up, but on July 24th, we saw a sudden 5% drop. Why? Simply because of leaked information about potential diplomatic peace talks between the US and Iran. It is almost absurd how sensitive this market is right now. A single unconfirmed rumor about peace talks can move global oil markets faster than actual physical cargo ships, literally wiping $3 to $5 off a barrel of oil in minutes. Section 3, DXY and Fed rates, the ultimate beneficiary. So we have oil prices spiking, and the ultimate beneficiary of all this chaos is actually the US dollar. The DXY just had its strongest week in 6 weeks, holding firm at 101.47. The dollar is basically being pumped up by three massive forces all at once. First, it's acting as a safe haven due to the global geopolitical conflicts. Second, US bond yields are soaring, sucking capital away from the euro, yen, and pound straight into the dollar. And third, the US economy is still running surprisingly hot, with jobless claims coming in at an incredibly robust 187,000.
And that brings us to a crucial number, 80%. Because oil is spiking, inflation fears are roaring right back. Combined with that strong jobs data, the market is now betting with an 80% probability that the Federal Reserve is going to hike interest rates in September 2026. This hawkish expectation doesn't just supercharge the dollar. It means everything from credit card rates to mortgages could stay painfully high for the everyday consumer.
Section 4, the paradox of gold, a safe haven sold off. Now, traditionally, when there's a war, gold goes up, right? It's the ultimate safe asset. But right now, it is fighting a brutal, desperate battle just to hold on to the $4,000 per ounce psychological mart. In fact, compared to its historical peak of nearly $5,600 an ounce back in January 2026, gold has plummeted by almost 28%. Short-term forecasts are actually bearish, warning of a potential drop down to $3,910. It is genuinely baffling at first glance to see this happening during a global geopolitical crisis. But this creates what analysts are calling a double-edged sword domino effect, and it perfectly solves our paradox. Here's how it works. Step 1, the war drives oil prices up. Step 2, high oil prices trigger inflation fears, which makes the Fed hawkish. They want to raise rates. Step 3, because rates are expected to rise, bond yields and the US dollar surge. And finally, step 4, because the dollar is so strong and yields are high, investors dump gold, which pays no interest whatsoever, to chase those guaranteed yields instead. This seamless chain reaction is exactly why gold is bleeding out despite the turmoil in the Middle East. Section 5, AI bubble fears and how tech takes a hit.
So the macro commodity dominoes are now falling squarely onto the equity markets, and the divide here is stark. While the broader S&P 500 is moving in a mild, sideways pattern after dropping from its all-time high, the tech-heavy Nasdaq 100 has taken an absolute cliff dive. It has completely evaporated about 8.4% of its value from its historical peak. The high interest rate environment we just talked about is absolutely crushing it.
So what exactly is driving this tech collapse? Well, first, we're seeing a ruthless, unforgiving sell-off in the Magnificent Seven tech stocks triggered directly by a massive earnings shock from Tesla and Alphabet. But deeper than that, despite all the recent hype, there is a growing, heavy fear across the market of an AI capex bubble. That's the idea that these companies are spending way too much on artificial intelligence infrastructure without the actual returns to justify it. Because of this, analysts project the Nasdaq could see further corrections, potentially dropping down to around the 27,630-point mark. This is exactly the kind of stuff that might be pulling down your 401k right now. All of this is completely rewriting market psychology. Just a year ago, we were sitting in extreme greed at a comfortable 75 on the index. Today, we've plunged right down into fear, registering a level of just 39. Investors are looking at those inflated tech valuations and high interest rates, and they're aggressively locking in their profits and fleeing straight to safety.
Section 6, Bitcoin at crossroads, resilience tested.
Initially, Bitcoin actually stood incredibly strong. While the stock market and gold were facing immense selling pressure, Bitcoin held its ground admirably, hovering right around that $64,000 mark. But, it isn't immune to gravity. As those US bond yields continue to rise, they act like a massive vacuum, sucking capital right out of risk-on assets. As a result, the underlying demand for Bitcoin is currently weakening. But hey, it's not all doom and gloom for crypto. Digging into the on-chain data provided by Glassnode reveals something pretty counterintuitive to the broader market panic. Their analysis suggests that despite the current weakness, the Bitcoin market might actually be in the, quote, early innings of a bottoming process. It is super intriguing to see signs that a structural foundation could be forming right under the surface, even if we haven't seen the final sustainable bottom just yet.
But ultimately, Bitcoin, just like gold, oil, the dollar, and the Nasdaq, is standing at a massive crossroads. Everything we've mapped out today hinges entirely on the upcoming Federal Open Market Committee meeting on July 29th. If the Fed confirms the 80% probability of a rate hike and maintains a hardline hawkish tone, we could see Bitcoin resume its downward trend and the dollar surge even higher. But if they loosen up, the entire domino effect could reverse. Will the Fed stay the course, or will they blink? That is the ultimate question moving into next week. Thanks for joining me on this explainer, and I hope this gives you a much clearer lens to view the markets through.